So it's a brand new year, 2025, and you may be thinking this is the year you want to start your investing journey if you haven't done so already. But in this video, I want to go over a couple of things that you should consider before you start investing. Now, I'll also have a video going up after this one which talks all about the best ways to get started investing in 2025. So maybe after you've watched this one, you may want to consider checking that one out as well. But let's jump straight into it. The first thing that you're going to want to do before getting started with investing is build an emergency fund. Essentially what this is, as it says on the tin, is just a fund of money that you can dip into in case of emergencies. The reason for this is that they say any money that you're investing, you should leave there for at least 3 to 5 years to give it the best chance of growing from the initial investment. So let's say, for example, you start investing, you put €1,000 into the stock market, you don't have an emergency fund set up, and then all of a sudden something happens with your car, you need to get 4 new tires or something like that onto the car. And then you also don't have a pot of money, so you end up borrowing, or you end up accessing the money that was in the stock market that you just put in, and it may be down even 5, 6, 10% depending on whatever day you go and access it on. Whereas if you invest that money in the stock market but you also had an emergency fund set aside, you can leave that money continuing to do what it does. As I mentioned, if it is down in that scenario, over the course of 3 to 5 years, the stock market generally is positive. So there's a much better likelihood if you leave that money in there in 3 to 5 years, if you did need to access it, that it would be more than your initial investment. Obviously no guarantees, but that's the general guidelines. So essentially what we're trying to achieve in an emergency fund is just a place that you can access money for kind of things that come up in an emergency, I guess, and then you don't have to touch your investments. Now the exact amount for this will depend on the person. Maybe 500 is enough for you, maybe 1,000. I know a lot of people say around 1,000 is a good place to start. And then for other people it may make more sense. For example, if you are self-employed, you may want to build up something like a 3 to 6 month emergency fund, as your scenario might be a little bit more different and things can change quite quickly. So I think for most people around that €1,000 mark is a good thing to aim for, and that will give you a good foundation to be able to start with your investing. And of course you can have this emergency fund anywhere. For me personally, in Ireland, I put it in a credit union because it's easy to access, but not so easy that I could end up, just transferring the funds to my bank account on the same day and then end up blowing that money. So it's still easily accessible within 24 hours, but it's not somewhere that I can kind of see every single day on my main banking app and then I can just take money from. So of course, up to you, anywhere is fine, but I personally have it in the credit union. The next thing to consider then is paying off high interest debt. So let's say, for example, that you have a car loan outstanding. This may be anywhere from 7, 8, 9, 10% wherever you got your loan from. And it makes much more sense for you to concentrate on paying that down, because essentially you're paying interest on this. If you go and put money into the stock market that could have been used paying off the loan, whereas on one side, if you pay off the loan, you're guaranteed to be saving yourself interest, where on the other side, if you invest in the stock market, you may lose money. It's not guaranteed that you're going to gain money. So essentially you're risking money here in the stock market at a chance of maybe a 7, 8, 9, 10% return, whereas if you just focused on the small short-term car loan, and you can guarantee yourself that you'll be paying less interest if you're paying down the principal on that quicker. So in short, aside from the mortgage, of course, if you have a mortgage, paying down short-term debt makes a lot more sense than trying to make money in the stock market. If you do find yourself in a position where you do have a couple of loans that you're trying to get rid of, a method called the Snowball Method might make sense if you haven't heard of it before. Essentially what this is you don't go for the high interest loan first, which may make sense in a lot of cases. Instead what you do is you tackle the one with the lowest principal amount. So let's say you have a €5,000 loan and you have a €10,000 loan, but the 10,000 is on a higher interest. You may think it makes more sense to pay that off, and in some cases it may do. But what the Snowball Method is, it's kind of like a psychological way to get over the fact that you have loans and get a kind of win under your belt of clearing off the loans, is that you'd actually tackle the lower one first despite the interest rate, and then once you have that one cleared off, all of a sudden instead of 2 loans you now have 1 loan, and then that is a good psychological win and helps you get into the mindset of paying things off. So the Snowball Method is something you may want to apply to your financial situation. The next thing, especially in Ireland, is to make use of a pension. This is especially important if your employer is willing to give an employer contribution. So in a lot of companies you may see them, if you do 5%, they also will do 5%. There's even more attractive offers out there as well. So whether you're in the 20% tax bracket or the 40% tax bracket, depending on your income, you will get that amount off pension contribution. So if you're on the 20% tax bracket, for every €100 you put in, your pension will rise by €100, but it'll only actually cost you net €80. And then of course if you're on the 40%, for every €100, again your pension will rise by €100, but that will only cost you €60 in terms of the net. And then as I said, if your employer is contributing on top of that as well, it just makes a whole lot of sense. So if you don't have a lot of disposable income and you're thinking maybe I'll invest €100 a month into the stock market, just myself via apps like Trading212 for example, if you don't have your pension set up, that €100 might make a lot more sense going into a pension. Now, of course, it is important to remember that with pensions, it's not until retirement that you'll be looking at taking this money out. So if you do want to buy a house in the meantime or something, I do understand the appeal of wanting to put that into just savings or the stock market. But I do think if you can do a bit of forward planning, think about yourself in retirement, pensions definitely make sense to start as early as you can. The next thing I would do is kind of decide on a strategy. This is a difficult thing to do, and I'll talk about this a little bit more in the video where I'm talking all about how to get started investing in 2025. But it's important to know what you want to achieve from investing. As I mentioned earlier, are you just trying to afford maybe a house? Are you trying to afford a car? Something along these lines, something that you don't want to wait till retirement for? Or is this something you want to build out along with your pension, where you're just going to build up a big portfolio and live off the dividends? Is that the kind of thing you want to achieve? So look into, dividend investing, look into just growth stock investing, look into just investing in the S&P 500, decide kind of what would suit your needs. And then on the back of that, some different investment products come with different tax laws, so make sure you familiarize your country's tax laws and understand if I decide to invest in individual stocks or the S&P 500 that you'll pay different taxes, especially in the case of Ireland anyway, for each of those investment types. So there's a couple of tips that I would consider before getting started investing in 2025. Again, the main ones are build up that emergency fund and concentrate on paying down that short-term debt as well. And then you should be in a good position to be able to start thinking about how you're going to invest in 2025. Let me and others know down in the comment section below if you have any other tips that you would consider before getting started investing, or just general finance tips that you think would help people. Thanks so much for watching. Happy New Year to everybody and best of luck in 2025. Catch you in another video.